Welcome to the next instalment where we look at one graph in 1 minute. Today we're looking at the leading economic indicators and how they can help us to forecast potential changes in the equity market. When we look at the leading economic indicators, we look at a myriad of factors, whether that be the strength of the labour market, the volume of goods that are being purchased by companies, the supply of credit, and even consumer sentiment. What's been interesting is that if we look at these collectively, we can see that when they have slowed down, it's often been a precursor to equity market weakness. And this makes sense. When jobs are less plentiful, when businesses are purchasing less goods, and when confidence is lower, we would expect corporate earnings to slow down as well. We can see this from the graph here, where in 2000, 2006, 2019, as represented by the green dotted lines, here, on these occasions, when the leading economic indicators fell, the equity market fell shortly afterwards. If we fast forward to today, the data doesn't quite fit, and we can see this where the orange lines are diverging. And why? Why is this happening? Well, the old playbook is not as reliable as it used to be, and multi-asset investing is an evolutionary discipline. Here at Canada Life Asset Management, we pride ourselves on being more pragmatic than dogmatic in our investment approach.